Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, Intel slams back down to earth. When President Trump promised Intel nearly $9 billion and gave it his vote of confidence as an America-first tech company, it looked like the start of a new era. Investors assumed new orders would flow to the troubled chipmaker. They bid up the stock 120% in just 5 months. And customer demand for Intel's products did explode. The AI data centers wanted Intel's processors. The demand was there. The opportunity was real. But Intel wasn't ready for it. That's a capital allocation story. That's a story about the difference between narrative and reality. That's a story about what happens when political enthusiasm, government money, and favorable sentiment meet a fundamentally broken operational machine. And that's a story about why those three things together still don't solve the underlying problem. Let me paint the picture. Executives at Intel revealed on their fourth quarter earnings call that the company was unprepared for a surge of orders for processors to put in AI data centers. After months of cutting capacity on its older production lines, the company couldn't meet the demand. The stock crashed 17%, wiping out more than $46 billion in market value in a single day. Stacy Rasgon, a semiconductor analyst at Bernstein, said it simply: the stock went vertical on vibes and tweets. In theory, they should be in place to capitalize on this demand, but they're not. What a shame. That quote captures everything. The stock went vertical on vibes, not on executed strategy, not on demonstrated operational improvement, not on proven ability to deliver, on vibes, on perception, on the narrative that the federal government was backing Intel and that Intel was poised for a comeback. And the shameful part is what actually happened. The company had the demand. The company had the Trump administration's support. The company had $9 billion in federal assistance. And the company couldn't execute. Now, let me understand why. This is where the operator decision-making becomes critical. Intel's problem isn't just that it lost market share to TSMC. It's not just that its manufacturing processes have fallen behind. The problem is that Intel's management made a series of capital allocation decisions that left the company unprepared for exactly the scenario that just happened. For months, Intel had been cutting capacity on its older production lines. They were making a bet. The bet was that the future would look a certain way. The bet was that older technology would become less important. The bet was that waiting for next-generation technology made sense. But then demand surged for exactly what they were cutting capacity on. Demand for CPUs, central processing units, the processors that go into AI data centers. Exactly what Intel should have been prepared to supply. Exactly what should have been an easy win for the company. And Intel couldn't deliver. Here's the deeper problem. Intel still has no customer lined up for its next-generation chip fabrication technology, known as 14A. In a chicken-or-egg dilemma, Intel is holding off on investing in new facilities until it has a customer. But no customer will commit until Intel proves it can deliver on the new technology. So Intel is pushing back its timeline. Meanwhile, its top competitor in manufacturing, Taiwan Semiconductor Manufacturing Company, is pouring capital into new U.S. chip fabrication plants. That's the operational reality. That's why vibes and tweets don't matter. TSMC is building. Intel is waiting. Trump invested $9 billion. The Trump administration converted federal grants into a U.S. stake in the company. SoftBank injected an additional $2 billion. NVIDIA entered into an agreement to design custom chips for Intel. And none of that mattered because the problem isn't capital. The problem is execution. The problem is that Intel's manufacturing is too slow. The problem is that Intel doesn't have the right customers for the right technology. The problem is structural, and capital can't solve it. Let me trace the capital allocation chain. Here's what happened. Trump sees Intel as an America-first company. Trump wants semiconductor manufacturing in the United States. Trump wants to break the dependence on Taiwan. Trump wants to create American champions in chip manufacturing. So Trump writes Intel a check for $9 billion. What was expected? That Intel would use the capital to upgrade its manufacturing. That Intel would accelerate its next-generation technology. That Intel would hire more engineers. That Intel would build new fabs. That new orders would flow in. That Intel would take market share from TSMC. What actually happened? Intel took the capital. The narrative changed. Investors bought the stock. But the operational machine didn't change. Intel was still slow. Intel still couldn't deliver on next-generation technology. Intel still didn't have customers lined up for 14A. And when demand actually appeared for what Intel could make right now, CPUs for AI data centers, Intel couldn't meet it because the company had spent months cutting capacity on older production lines. This is the trap of political capital. The trap is that it feels like progress. The trap is that it looks like change. The trap is that it creates enthusiasm and sentiment. But it doesn't fix the underlying problem. It doesn't make the manufacturing process faster. It doesn't attract customers. It doesn't change the incentives of the people inside the company. Now let me think about the opportunity cost. What was the alternative to Intel receiving $9 billion from the federal government? The alternative was that capital flowed to TSMC. The alternative was that the most advanced chip manufacturing in the world happened in Taiwan. The alternative was that the United States remained dependent on a single supplier in a hostile geopolitical environment. Trump chose to try to change that. Trump chose to invest in bringing chip manufacturing to America. That's a reasonable strategic goal. That's a national security goal. But the execution was a disaster. Intel took the money and couldn't execute. TSMC is eating Intel's lunch. TSMC has a clearer strategy, better execution, and more discipline. The hidden trade-off is that by backing Intel, by creating the narrative that Intel was fixed, Trump may have bought goodwill with the business community and the American people. But he squandered the opportunity to invest in actual manufacturing capacity that could compete with TSMC. He backed a company that couldn't execute. Let me extract the lessons, because there's something fundamental here about how government capital allocation differs from private capital allocation. First lesson: vibes and tweets can move stock prices, but they can't fix operations. Intel stock went up 120% because of narrative and government support. But the company was unprepared to capitalize on the demand that the narrative created. Investors who bought based on sentiment rather than operational reality got punished. Second lesson: cutting capacity in anticipation of future demand is a dangerous bet. Intel cut capacity on older production lines because management believed the future would favor new technology. But the future arrived and demanded the old technology. The company couldn't respond quickly because they had systematically eliminated the ability to produce at scale. Third lesson: government capital doesn't solve structural problems. Intel received $9 billion. That's capital. That's validation. That's political support. But none of that fixes the underlying problem. Intel's manufacturing is too slow, its next-generation technology isn't ready, and it doesn't have customers lined up for that technology. Capital can't fix that. Only execution can. Here's what I think is actually happening at Intel. The company received a massive capital infusion and political support. That created narrative momentum. The stock went vertical. Investors piled in. But the narrative and the reality diverged. The reality is that Intel is structurally broken. The reality is that the company can't execute. The reality is that when demand appeared for what Intel could actually make, the company didn't have the capacity. The operationally correct move would have been to maintain capacity on older production lines until the next generation technology was proven and ready. The operationally correct move would have been to have multiple customers lined up for 14A before cutting capacity on older stuff. The operationally correct move would have been to prioritize flexibility and readiness over the narrative of transformation. But Intel's management made different bets. They cut capacity. They pushed the timeline back. They waited for customers that never came. And when demand finally appeared, they couldn't meet it. That's a lesson in capital allocation under uncertainty. When you're uncertain about the future, when you don't know what customers will want, when you're in a transitional period, the right move is to maintain optionality. The right move is to keep capacity flexible. The right move is to be ready for multiple scenarios. Intel did the opposite. Intel bet that one scenario would happen. Intel cut capacity in preparation for that scenario. And when a different scenario appeared, Intel couldn't respond. Here's what I'll leave you with. President Trump invested $9 billion in Intel because he wanted to make America great again in semiconductors. That's a reasonable goal. But money doesn't fix operations. Vibes don't fix manufacturing. Government support doesn't fix execution. Intel remains broken. The company still has no customer for 14A. The company still can't respond quickly to changes in demand. The company still can't compete with TSMC. The stock went vertical on vibes and tweets. And when the market realized that vibes don't matter, that operations matter, that execution matters, the stock crashed. That's the difference between capital allocation and capital allocation reality. One is narrative. The other is whether the production line can actually run faster. Moving to next title, Eni, Repsol seek help with Venezuela payment. Eni and Repsol have been pumping gas from Venezuela's Perla gas field for years. They're producing 40% of Venezuela's gas supplies. The gas goes to Venezuela's state energy company, and the companies have been paid $0 since March. Now they're owed more than $6 billion combined, $3 billion each, and they're still producing. They're still pumping. They're still delivering gas into the void, hoping that someday they'll get paid. This is a capital allocation story. This is a story about sunk costs. This is a story about what happens when you're trapped in a geopolitical position that's neither walk away nor double down. This is a story about incentives at the White House, incentives in Europe, and incentives in Venezuela, all pulling in different directions. Let me set the context. Eni is an Italian energy giant. Repsol is a Spanish energy giant. Both companies have been operating in Venezuela for years. In 2015, they started up the Perla gas field, an offshore deposit that is one of the largest in South America. This was a significant capital investment. This was a long-term bet on Venezuelan energy. For years it worked. Eni and Repsol pumped gas. Venezuela's state energy company, PDVSA, consumed the gas, and Repsol and Eni were paid with shipments of crude oil. It was a barter arrangement. You produce the gas, we give you crude in return. That worked when relations were relatively stable. But then, Maduro was in power, and sanctions came. The Trump administration refused to renew licenses that provided limited waivers from U.S. sanctions on Venezuela. The barter arrangement shut down. No more crude oil payments. The companies were suddenly unpaid suppliers. And here's where the capital allocation trap emerges. Eni and Repsol had two choices. Choice 1, shut off the gas, stop production, cut losses, walk away from the investment and the asset. Choice 2, keep producing, keep delivering gas. Hope that someday the political situation changes and you get paid. Both companies chose choice 2. They kept producing. They kept pumping. They kept delivering gas to Venezuela for free. No payment, no compensation, just hope. Why would they do that? The article says it clearly. They don't want to shut off the gas because of the devastating impact that would have on the Venezuelan economy. They recognized that if the gas stopped flowing, Venezuela would face even deeper turmoil. And they took the long view that the asset was worth keeping. That's the rationalization. That's the capital allocation logic. If we keep producing now, taking losses, then when the political situation changes, when Maduro is gone, when sanctions are lifted, then we'll be the trusted operator. We'll be the company with experience and facilities and people. We'll be the company that helped Venezuela through the crisis. We'll have leverage when the negotiations happen. Now Maduro is gone. The political situation has changed, and Eni and Repsol are at the White House meeting with Trump. Repsol's CEO, Josu John Imaz, is there. Eni's CEO, Claudio Descalzi, is there. They're pitching the Trump administration on investing in Venezuelan oil production. But here's the catch. They're not raising the issue of the $6 billion they're owed. They're not demanding payment. They're not threatening to shut off the gas unless they get compensated. They're pitching Trump on future investments. They're saying, we have people, we have facilities, we have technical capabilities. We're ready to invest more in Venezuela. We can triple oil production in the next few years. They're making themselves useful. They're showing Trump that they can deliver on his Venezuela energy agenda. They're positioning themselves as the solution to Venezuela's energy crisis. And they're hoping that in return, Trump will give them a lifeline. Last week, the companies asked the Trump administration for licenses to export Venezuelan crude oil, which would be used to pay for their gas. That's the request. That's the ask. They need sanctions relief. They need the ability to get paid in oil instead of being stuck as unpaid suppliers. And Trump has the leverage. Trump has the power to grant those licenses. Trump controls the sanctions regime. Trump controls whether Eni and Repsol can receive Venezuelan crude as payment. So Eni and Repsol are in a hostage negotiation. They're not hostages, but they're negotiating with the person who holds the keys to their value. Now, let me think about what went wrong here. from a capital allocation perspective. These companies made a reasonable bet in 2015. Venezuela had oil and gas. The energy sector was important. Being a trusted operator in Venezuela seemed like it could pay off. They invested in the Perla gas field, but they didn't account for the political risk properly. They didn't account for sanctions. They didn't account for the possibility that they could produce for years without payment. They bet on political stability in Venezuela, and they lost that bet. Then, when the Trump administration shut down the barter arrangement in March, they faced the sunk cost trap. They had invested capital. They had built infrastructure. They had relationships. Walking away meant losing all of that. Staying meant producing for free, taking losses, and hoping that someday they'd get compensated. Most companies in this situation would walk away. Most companies would cut their losses. Most companies would decide that producing for free is economically irrational. But Eni and Repsol didn't. They stayed. They kept producing. They took the loss. Why? Because they believed the asset was worth something. Because they believed that when the political situation changed, when Maduro was gone, when the new government was in place, they'd have leverage. They'd be the trusted operator. They'd be the only major Western company still operating in Venezuela during the crisis. And they were right. Now Maduro is gone. Now there's a new government. Now there's an opportunity. And they're at the White House pitching their value to Trump. But here's the uncomfortable truth. Their leverage isn't as strong as they thought. Trump has his own geopolitical agenda. Trump wants Venezuelan oil production for energy security. Trump wants to diversify energy supply away from OPEC. Trump wants to rebuild Venezuela's economy, because a stable Venezuela is better for U.S. interests. So Trump will likely grant the licenses. Trump will likely allow Eni and Repsol to be paid in crude oil. But it's not because Eni and Repsol earned it through loyalty. It's because Trump needs them. It's because they're the only Western companies that still have experience and infrastructure in Venezuela. The payment Eni and Repsol get will be whatever Trump decides is reasonable. It will be whatever Trump thinks serves U.S. interests. Eni and Repsol have no real leverage. They're suppliers. They're useful suppliers. But they're not partners. Let me extract the lessons, because there's something fundamental here about geopolitical capital allocation. First lesson: sunk costs are real, but they shouldn't determine future decisions. Eni and Repsol had already invested in Venezuela. The investment was sunk. The right question wasn't, can we recover the investment? The right question was, is continuing to produce for free the best use of our capital going forward? The answer for most companies would have been no. But Eni and Repsol chose to stay, hoping that loyalty would pay off later. Second lesson: geopolitical risk is structural, not accidental. Venezuela isn't unstable because of bad luck. It's unstable because of systemic political and economic problems. Eni and Repsol knew this. They knew they were operating in a jurisdiction with high political risk. The right decision was to price that risk into the investment or not make the investment at all. Continuing to produce for free is betting that you can somehow extract value from an environment that is proven unreliable. Third lesson: leverage is determined by alternatives, not by loyalty or history. Eni and Repsol thought they had leverage because they were the trusted operators. But their leverage is that they're the only companies with experience in Venezuela. That's leverage for Trump. That's not leverage for Eni and Repsol. When you need the other side more than they need you, you don't have leverage. You have desperation. Here's what I think is actually happening. Eni and Repsol are going to get paid. Trump will grant the licenses. They'll receive crude oil in compensation. They'll get some of their $6 billion back, but they'll get less than they're owed. They'll get partial compensation. And they'll probably agree to keep producing at reduced rates or under different terms. They'll agree because the alternative is to walk away with nothing. And that's the trap. That's the sunk cost mentality at scale. That's what happens when you stay in a bad situation hoping that loyalty will eventually pay off. You end up negotiating from weakness. You end up taking whatever you can get because the alternative is losing everything. The right move for Eni and Repsol looking back would have been to walk away in 2015 or 2016, before Venezuela's political situation deteriorated further. The right move would have been to recognize that operating in an unstable jurisdiction with limited payment history was too risky. But companies don't work that way. Companies make bets. Then, when those bets go bad, they keep hoping. They keep investing. They keep producing. They hope that somehow the situation will improve, and they'll be made whole. And sometimes it does improve. Maduro is gone. The political situation has changed. Eni and Repsol might get paid. They might recover some of their losses, but they've learned an expensive lesson. Geopolitical risk is real, and hope is not a capital allocation strategy. Here's what I'll leave you with. Eni and Repsol are trapped in a negotiation with the Trump administration over $6 billion in unpaid debt. They're hoping that their loyalty and experience in Venezuela will translate into leverage. But leverage is determined by what you offer and what you have to lose. They offer experience. They have to lose their investment. Trump offers sanctions relief. He has to lose nothing. Guess who has leverage in that negotiation? Not Eni and Repsol. Moving to next title, ETS seeks buyer or investors for GRE. TOEFL tests. The ETS, a nonprofit, owns the GRE and the TOEFL. These aren't small businesses. The GRE has been a pillar of admissions to graduate programs for nearly a century. The TOEFL is used by U.S. universities to assess international students' English language proficiency. These tests are gatekeepers. These tests have defined educational access in America. Now ETS is seeking a buyer. The company is in talks to sell the exams or find strategic investors. They're looking for bids of around $500 million. That's the story. A century-old institution with a monopoly on standardized testing is worth $500 million, and it's looking for someone to take it off their hands. This is a capital allocation story. This is a story about moats that disappear. This is a story about the power of optionality to destroy entrenched businesses. This is a story about how the internet and innovation can make a centuries-old institution obsolete in just a few years. Let me set the stage. The GRE is the Graduate Record Examination. It's been administered by ETS since 1936, nearly 100 years. For that entire period, if you wanted to go to graduate school in America, you took the GRE. There was no alternative. The test was the standard. Universities required it. Applicants took it. And ETS controlled the entire value chain. The TOEFL is the test of English as a foreign language. It's used by American universities to assess whether international students have sufficient English proficiency. Again, ETS controlled this market. If you wanted to apply to a U.S. university as an international student, you needed to take the TOEFL, and ETS administered it. These are network effects businesses. Universities use the GRE because other universities use the GRE. Students take the GRE because universities want the GRE. It's self-reinforcing. It's a moat. For decades, this moat was unbreakable. ETS had pricing power. They could charge whatever they wanted. The tests were expensive. Universities couldn't easily defect because every other university was also using the same test. Students couldn't refuse to take the test because they had to prove their competence to universities. It was a beautiful business. ETS is a nonprofit, so they don't report profit numbers. But you can imagine the economics. The tests cost money to take, the revenue was recurring. The costs were mostly fixed. The margins were enormous. And then, in 2016, universities started making the GRE optional. That's the inflection point. That's when everything changed. Why would universities make the GRE optional? Because they realized it wasn't correlated strongly enough with graduate success. Because they wanted to increase diversity in their graduate programs. Because they recognized that the GRE was selecting for test-taking ability, not scholarly ability. And then the pandemic happened. During the pandemic, many universities moved the GRE optional, not because of philosophical reasons, but because testing centers were closed and students couldn't take the test. Now let me show you the numbers. Look at what happened. In 2020-21, 350,000 people took the GRE. In 2024-25, 200,000 people took the GRE. That's a drop of 57% in 4 years. Think about what that means. ETS had the market. The test was required. The revenue was predictable. And then, in just 4 years, the test-taking population was cut in half. That's not a cyclical decline. That's not a temporary problem. That's structural damage to the business model. And it's not just the raw number. It's the composition of the decline. The students who stopped taking the GRE were the marginal applicants. They were the students who were on the borderline. They were the students who might not have gotten into graduate school based on their test scores. Now they could apply without the test, and universities could decide whether to admit them based on other criteria. For the universities, this is great. They have more flexibility. They can admit students based on demonstrated capability rather than test scores. For ETS, this is a disaster. The GRE went from being required to optional. Required means recurring revenue. Optional means optional revenue. Now let's talk about the TOEFL. The TOEFL has a similar story, but with the additional wrinkle of direct disruption. Duolingo created a language learning app. Duolingo also created a language test. The Duolingo English test costs less than the TOEFL. Students can take it from home. They can take it on their computer. They don't have to go to a testing center. The TOEFL requires students to go to a physical testing center. You have to find a center near you. You have to schedule the test. You have to show up in person. The TOEFL is expensive and inconvenient. Duolingo is cheap and convenient. And universities have started accepting the Duolingo English test in place of the TOEFL. So the TOEFL is being disrupted on two fronts. First, fewer international students are applying to U.S. universities because of Trump's campaign to limit international enrollment. That's a macro headwind. Second, the students who do apply are increasingly taking the Duolingo test instead of the TOEFL because it's cheaper, faster, and more convenient. The TOEFL went from being the default test for international students to being one option among many, and it's the expensive, inconvenient option. Now let me think about what this means for capital allocation. ETS built an institution based on a fundamental assumption that universities would always require these tests. That assumption turned out to be false. The business model was dependent on a moat that was dependent on network effects, but the moat was actually fragile. The moat was dependent on coordination among universities, and once the coordination broke down, the moat disappeared. Here's how it happened. Universities made the GRE optional. Once a few universities made it optional, other universities felt pressure to do the same. They didn't want to disadvantage their applicants, so they made it optional too. And suddenly, the network effect was gone. It's like credit cards. If every merchant required you to pay with a credit card, then credit cards would have enormous power. But if merchants start accepting other forms of payment, then credit cards have to compete. They have to offer value. They can't just rest on the moat. The same thing happened to the GRE. It went from being a required network to being one data point among many. What was the cost of this transition to ETS? The cost was the entire revenue stream. ETS went from a business where 350,000 students per year took the test to a business where 200,000 students per year take the test. That's a 57% decline in the core customer metric. And the decline is still happening. The pressure isn't over. International enrollment limits are still being discussed. The TOEFL is still being disrupted by Duolingo. The GRE is still optional. So now ETS is looking for a buyer. They're looking for someone to take the GRE and TOEFL off their hands, and they're willing to accept $500 million as a valuation. That's the price of disruption. That's the price of a broken moat. That's what it costs to sell a century-old institution when the institution is no longer necessary. Let me extract the lessons because there's something fundamental here about moats and disruption. First lesson, moats that depend on coordination are fragile. The GRE was powerful as long as all universities coordinated to require it. The moment that coordination broke, the moat disappeared. The lesson is that network effects only work if there's high switching cost or high value in staying coordinated. The TOEFL and GRE didn't have that. They had inertia, they had habit, but they didn't have real switching costs. Second lesson, optionality destroys pricing power. As long as the GRE was required, ETS had pricing power. Universities had to accept it, students had to take it. Once it became optional, that power disappeared. Suddenly, universities could choose alternatives. Students could opt out, and that optionality cascaded. Now ETS is looking for buyers. Third lesson, business models dependent on status quo are vulnerable to disruption. ETS's entire business model was built on the assumption that the GRE and TOEFL would always be required. The business wasn't built on delivering superior value. It wasn't built on constantly improving the tests. It wasn't built on adapting to changing customer needs. It was built on inertia. The moment the status quo changed, the entire business collapsed. Here's what I think is actually happening. ETS is trying to sell or find an investor for these tests because the business model is broken and it can't be fixed from the inside. Universities have moved on. Students have alternatives. The value proposition of the GRE and TOEFL has declined dramatically. But there's a buyer. Someone wants to buy the GRE and TOEFL because even though the businesses are damaged, they still have some value. They still have hundreds of thousands of test takers per year. They still have universities using the tests. There's still some revenue to extract. But the real question is, what will the buyer do with these tests? Will they try to rebuild them? Will they try to make them optional alternatives to other tests? Will they try to compete on convenience or price? The problem is that the market has moved on. Universities are making decisions based on what's best for their students, not based on what tests are available. Students are choosing tests based on convenience and cost. The GRE and TOEFL are legacy products in a market that's moved on. So the buyer will probably be a private equity firm or a strategic investor who understands that these businesses are in decline but can still be milked for cash flow. They'll probably keep the tests as they are, extract whatever profit remains, and let the market consolidate around cheaper and more convenient alternatives. Duolingo has already won the English proficiency test market. Other tests are emerging for graduate admissions. The GRE and TOEFL will probably survive as legacy products, but they'll never be what they once were. Here's what I'll leave you with. ETS owned a monopoly for nearly a century. The monopoly was based on a moat that seemed unbreakable. And then the moat disappeared in just a few years because the underlying value proposition changed. Universities and students found better alternatives. Optionality killed pricing power. And ETS went from being an institution that defined educational access to being a distressed seller looking for someone to take the tests off their hands. That's not a cyclical decline. That's not a temporary challenge. That's the end of a business model. And $500 million is what it costs to sell the remains. Moving to next title, Startup Mines Rare Earths from Old Tech. There's a warehouse in Mesa, Arizona. Inside that warehouse are 2,000 metric tons of junk. Old electronic equipment, e-bikes, drones, MRI scanners, hard disk drives, expired gadgets that would normally go to a recycling facility and get sorted for copper, aluminum, precious metals. But the people who run this warehouse see something different. They see rare earth metals. They see neodymium. They see dysprosium. They see the materials that power magnets, electromagnets, the components that make electric motors spin. They see America's next rare earth mine. This is a capital allocation story. This is a story about supply chain strategy. This is a story about how a supply chain crisis becomes an opportunity. And it's a story about whether the economics of recycling rare earths actually work, or whether it's a venture that only makes sense because of geopolitical risk and government support. Let me set the stage. China mines 3/5 of the world's rare earths. China has more than 90% of the capacity to refine them. That's not just market share. That's dominance. That's a chokehold. And last year, Beijing used that chokehold as a weapon. China restricted rare earth exports in the trade war with the United States. Suddenly, Western manufacturers realized how dependent they are on Chinese rare earths. Suddenly, the idea of a domestic rare earth supply chain became a strategic priority. Not a nice-to-have, a strategic priority. New mining projects are underway in the United States and Europe. But here's the problem. Building a mine takes a decade. A decade of permitting, environmental reviews, construction, testing. A decade is too long when you're trying to fix a supply chain crisis right now. And that's where Cyclic Materials comes in. Cyclic was founded by Ahmad Gahreman, an Iranian-born mining expert who developed a recycling process while working as a professor at Queen's University in Canada. The company's thesis is simple. Don't mine new rare earths from the ground. Recycle them from old electronics. Here's what makes this interesting. Gahreman calls the electronic products thrown away in North America every year the world's largest above-ground deposit of rare earths. Not below ground, above ground, sitting in landfills, warehouses, recycling centers, just waiting to be extracted. Globally, less than 1% of the rare earth metals in expired technology gets recycled. Why? Because it's not economical to do so. Because separating the magnets from the other materials and parts they're embedded in hasn't been cost-effective, especially when access to low-cost products from China has been cheap and available. But now China has weaponized that supply. And suddenly, recycling doesn't have to be cheap. It just has to be cheaper than building a new mine and faster than waiting for new mining to come online. Cyclic raised $75 million from investors, led by T. Rowe Price. That brings the total amount raised to $162 million. The company plans to expand recycling operations at new sites in the US and Europe. The flagship facility is in Mesa, Arizona. It will have the capacity to handle 25,000 tons of old equipment per year. That would correspond to 250 tons of rare earth oxides. 250 tons per year. Cyclic estimates U.S. demand at between 8,000 and 13,000 tons. So the Mesa facility would supply somewhere between 2 and 3% of U.S. demand for rare earth oxides. That's not a rounding error, but it's also not enough to break China's dominance by itself. But here's where the economics get interesting. The recycling process doesn't just yield rare earths, it yields other metals. The Mesa plant is projected to yield 2,500 tons of copper in its first 2 years of operation. At current record prices, near $13,000 per ton, that's worth over $30 million. More than the benchmark price of roughly $25 million for 250 tons of mixed rare earth oxides. Let me repeat that because it's critical. The byproduct of rare earth recycling, copper, is worth more than the primary product. The copper alone is worth more than the rare earths. That changes the economics entirely. That means Cyclic doesn't need rare earths to be economically viable. The company can make money on copper and consider the rare earths a bonus. That's capital allocation insight. That's understanding the full value chain. Cyclic has sourced waste from more than 500 suppliers. Rental e-bike operator Lime has sent a few hundred old electric motors. One electronic waste recycler has sent the company 70 tons of hard drives. The company has deals to supply copper to Glencore, a major commodities company. But here's the bottleneck: getting hold of enough waste. A McKinsey partner noted that junked gadgets mostly wind up in recycling operations that don't harvest rare earths, and most post-consumer scrap is sitting in cupboards at home, not in commercial recycling streams. That's a collection problem. That's a logistics problem. That's a capital allocation challenge. Cyclic has to build supply chains to collect old electronics. And it has to do that while competing with traditional e-waste recyclers who are just looking for copper and aluminum. Now let me think about the government's role here. The Defense Department committed $80 million to ReElement Technologies, which processes recycled tech and mined ore. A $620 million loan went to Vulcan Elements, a maker of rare earth magnets. The Pentagon took a 15% stake in MP Materials, a rare earth miner. Apple committed $500 million to recycling infrastructure at MP Materials' Mountain Pass mine in California. A bipartisan group of lawmakers proposed arming a new agency with $2.5 billion to support domestic supply chains for rare earths and other critical materials, including through recycling. That's government capital allocation. That's strategic industrial policy. That's the United States deciding that rare earth independence is worth subsidizing. Here's what I think is actually happening. The geopolitical risk is real. China can weaponize rare earth supply. The United States needs a domestic alternative. Recycling is faster than mining. Cyclic is the most promising recycling company, but the economics are fragile. They depend on copper prices staying high. They depend on being able to scale up collection networks. They depend on continued government support. They depend on the supply chain not normalizing. If China eases its rare earth restrictions, if trade tensions cool, if new mining projects come online in the U.S., then the economics of recycling look less attractive. The prices won't support the capital investment. But right now, at this moment, the incentives are all aligned. The government wants domestic rare earth supply. Private investors see geopolitical risk. Copper is at record prices. And Cyclic has a credible founder with a real process. Let me extract the lessons because there's something fundamental here about how geopolitical risk changes capital allocation. First lesson: geopolitical risk can make economically marginal businesses viable. Recycling rare earths wouldn't make sense on pure economic grounds if China were a reliable supplier. But with China weaponizing supply, recycling becomes strategic. That changes the capital allocation calculus. Cyclic doesn't have to be the cheapest way to get rare earths. It has to be a way to get rare earths without depending on an unreliable supplier. Second lesson: byproducts matter. Cyclic's copper byproduct is worth more than the primary product. That's capital allocation insight that most people miss. The company isn't dependent on rare earth prices to be viable. The company can make money on copper and break even, or profit on rare earths. Third lesson. Government capital allocation in strategic industries is about optionality, not efficiency. The Pentagon isn't backing MP materials or Vulcan elements because they're the cheapest way to get rare earths. They're backing them because they want options. They want domestic supply. They want independence from China. That's a premium they're willing to pay. Here's what I think the arc will be. Cyclic will prove the process works. The company will scale to a few facilities in the US and Europe. It will supply a meaningful percentage of Western rare earth demand. That will buy time for mining projects to come online. But Cyclic is not the solution. It's the bridge. It's the way to maintain independence while new mining infrastructure is being built. And that's actually a valuable role. Bridges aren't as exciting as the destination, but they're often more valuable. The real question is, what happens to Cyclic if the geopolitical situation normalizes? What happens if trade tensions ease? What happens if China becomes a reliable supplier again? Then the economics don't work. Then it's not worth recycling rare earths. Then Cyclic is a business that doesn't make sense without government support. That's the tail risk. That's the opportunity cost. That's what investors in Cyclic need to think about. But for now, at this moment, the thesis is sound. Geopolitical risk is real. Supply chain risk is real. Copper is profitable. And Cyclic has a legitimate founder with a real process. Here's what I'll leave you with. Ahmad Ghorayman is right that the electronic products thrown away in North America every year represent the world's largest above-ground deposit of rare earths. And it's a shame that we're not mining it. But we're only not mining it because the economics don't work without geopolitical risk. And that's the invisible subsidy running through the entire rare earth recycling industry right now. Now, towards last article, an heir to Buffett who fell. By early 2011, David Sokol had established his stature at Berkshire Hathaway and was widely seen as Warren Buffett's successor. He was Buffett's chosen heir. He was the man Buffett wanted to run his empire after him. Then in March, Berkshire bought chemicals company Lubrizol in a $9 billion deal. Soon after, it emerged that Sokol had purchased about $10 million of shares of Lubrizol 2 months earlier, and that the deal had come at his suggestion. The value of Sokol's stake rose $3 million on the acquisition. That's the story. That's the fall. That's how the heir apparent became a cautionary tale in a matter of weeks. This is a capital allocation story. This is a story about incentives. This is a story about how success can create blind spots. And it's a story about how a single uncharacteristic decision can undo decades of building. Let me set the stage. Was born the youngest of 5 children to a grocery store manager and a homemaker. He lived at home while attending the University of Nebraska. He married during his junior year. He lived in a trailer. He was building his life from scratch. He studied structural engineering and then got into business. In 1991, he was named CEO of Cal Energy, a company focused on waste energy projects. He turned that company into a sprawling utility through aggressive acquisitions. He purchased Mid-American Energy in 1998 and took on its name. Sokol earned a reputation for being hard-driving and sometimes difficult. Some people nicknamed him the Great Young God, a nod to his intelligence and his ego. He was demanding. He expected others to work as hard as he did. He kept a notebook where he ranked employees in the order in which he would terminate them if forced to do so, one at a time. That's the operating style. That's the intensity. That's the focus on execution and drive. In 1990, his youngest child, David Sokol Jr., died from Hodgkin's lymphoma, a few weeks after graduating from high school. In interviews, Sokol described it as extraordinary to watch his inner strength during that period. In late 1990, Berkshire purchased almost 80% of Mid-American Energy. Buffett eventually bought the rest. Greg Abel was Mid-American's president, but Buffett's public accolades were directed at Sokol, the company's CEO. Buffett said, "If I only had 2 draft picks out of American business, Walter Scott and David Sokol are the ones I would choose for this industry." That's an extraordinary endorsement. That's Buffett anointing Sokol as his successor. Sokol continued to oversee Mid-American's growth. He also turned around NetJets, Berkshire's business offering shared ownership of jets to wealthy companies and individuals. His ability to improve the fortunes of Berkshire businesses, from roofing and insulation to real estate brokering to fractional jet ownership, earned consistent praise from Buffett. Sokol was the star. Sokol was the one who could fix broken businesses. In 2008, Sokol led a $230 million investment in BYD, a Chinese battery maker. He traveled to China to investigate the company. Berkshire bought a 9.9% stake. BYD went on to surpass Tesla as the world's top seller of electric vehicles. It was a home run. Sokol was winning. Sokol was making the right calls. Sokol was Buffett's chosen one. Then, in March 2011, Berkshire bought Lubrizol. Sokol suggested the deal, and it emerged that Sokol had purchased about $10 million of Lubrizol shares 2 months earlier. Now let me think about what Sokol was thinking. He's a successful operator. He's made hundreds of millions of dollars. He's been validated by Buffett repeatedly. He's the heir apparent. He's one of the greatest business operators in America, and he purchases shares of a company 2 months before suggesting to Berkshire that they buy it. The shares go up $3 million when Berkshire makes the acquisition public. What was the reasoning? Did Sokol think it was fine because he disclosed it? Did Sokol think the profit was so small relative to his net worth that it didn't matter? Did Sokol think it was just good capital allocation, seeing a good deal and betting on it himself? I don't know. But here's what we do know. Sokol resigned from Berkshire shortly after his purchase became public. Buffett said at the time that the stock purchases weren't a factor in Sokol's decision, saying Sokol expressed a desire to spend more time investing his family's resources. But then an audit committee report, which Berkshire later removed from its online archives, said Sokol's trading violated the highest standards of business ethics. Not gray area, not questionable, violated. At Berkshire's annual meeting, Buffett expressed bewilderment about Sokol's decision. Buffett said he made about $24 million that year. He expressed confusion about why Sokol would need the extra $3 million. Dave did not disguise the trading, which, that's somewhat inexplicable, Buffett said. That's the reality check. That's Buffett being genuinely confused. Sokol didn't hide the trade. The profit was immaterial relative to his net worth. The deal was good for Berkshire, but it violated the highest standards of business ethics. Why? Because the appearance of conflict of interest matters. Because the perception that you're benefiting personally from a deal matters. Because in a company built on trust and integrity, taking even a small personal benefit from a business deal is corrosive. Let me extract the lessons, because there's something fundamental here about how success can create blind spots. First lesson: success can make you overconfident in your judgment. Sokol had made hundreds of millions of dollars for Berkshire. He had turned around broken businesses. He had found home runs like BYD. He had been validated repeatedly by Buffett. That success probably made him think, my judgment is good, so if I think this deal is right for Berkshire, it's right. And if I also think Lubrizol stock is going to go up, then I should buy it. But he was wrong. The rules don't change based on your track record. The standards of business ethics don't relax because you've been successful. In fact, the opposite is true. The higher you go, the more careful you have to be about the appearance of impropriety. Second lesson: incentives matter, and conflicts of interest corrupt judgment. Sokol suggested a $9 billion deal to Berkshire, and he stood to benefit personally by $3 million from that suggestion. That creates a conflict. Not a huge conflict, but a conflict. And that conflict, even if it doesn't change the decision, creates the appearance that the decision might be tainted. Third lesson: integrity is not optional at the top. Berkshire's entire business model is built on trust. Investors trust Buffett. Managers trust Buffett. Shareholders trust that Buffett is making decisions in their interest, not his own. If people see Berkshire executives making personal gains from Berkshire deals, the trust erodes. Sokol had one uncharacteristic decision. 1. He was not disguising anything. He was not doing anything illegal, but he was doing something that violated the highest standards of business ethics. And that was enough. Here's what I think actually happened. Sokol saw an investment opportunity. He took it. He didn't see it as a conflict because he disclosed it. He didn't see it as a problem because the profit was small. He didn't see it as unethical because the deal was good for Berkshire. But he was wrong. The standards at Berkshire Hathaway and at institutions built on integrity are higher than legal or disclosed. The standards are beyond reproach. The standards are no conflicts of interest, period. Sokol violated those standards once, And that was enough to end his career as Buffett's successor. In the aftermath, Sokol's attorney criticized the way Berkshire treated him, saying Sokol deserved better. The attorney said Buffett was told about Sokol's ownership of Lubrizol stock, but the audit committee still concluded that his trading violated the highest standards of business ethics. Since leaving Berkshire, Sokol hasn't had much contact with Berkshire executives. He was a man of talent and integrity who was poised to replace Buffett, and one uncharacteristic and fateful act got in the way. A Berkshire shareholder said it this way: "By all appearances, Sokol was a man of integrity and talent who was poised to replace Buffett. One uncharacteristic and fateful act got in the way." That's the tragedy. That's the capital allocation lesson. That's what happens when success creates overconfidence and you make one decision that violates your principles. Sokol didn't steal. He didn't deceive anyone. He didn't hide the trade. He just took a small personal benefit from a business decision, and that was enough to destroy his legacy. Here's what I'll leave you with. David Sokol built Berkshire businesses. He turned around broken operations. He found home-run investments. He was one of the greatest business operators of his generation. And then he made one decision that suggested his judgment wasn't as good as everyone thought. One decision that suggested he could be influenced by personal gain. One decision that violated the highest standards of business ethics. And that was enough, because at the top, integrity is not negotiable, and a single uncharacteristic decision is enough to end everything you've built. This is Avi. Like and subscribe. On to the next.